is by definition has to be the point of maximum bearishness, and I think we're there. For the market to go up, the news does not have to be good. It just has to be less bad than what has already been discounted. So I think what Barton might have been a little early because we've come back to these lows, but importantly in the lows that we've seen in the last week or so, far fewer companies have made new lows. Most companies made their lows back in the fall. That is part of a bottoming process that usually takes something on the order of 6 months or so, 6 months to 9 months at the outside to reach. Okay, this is right at the bottom in 1974, the previous biggest decline that we'd seen. The world of finance is in its biggest mess in over 40 years. Capitalism is being tested everywhere. Many people believe it is dying. There's not a major stock market where the price tag on quoted companies has not been marked down by at least 1/3. The reduction has mostly been near to half or 2/3, and the vicissitudes of the banking fraternity have included some of the worst bank failures since the 1930s. This was within days of the low in 1974. Okay, October 14th, 1990. This is just after the market low of 1990. This 1990 was the last time we had a collateral-driven, asset-driven problem in the U.S. Capital markets. These are 3 strategists who were interviewed on this day. First one says, I don't think we've seen the bottom of either the market or the recession. We have another couple of years to go. Consider that how that comports with what we're hearing today about how far we have to go. I'm talking 1991 on the downside, probably starting to come out of it in 1992. Next person, this is Charlie Clow, the chief investment strategist at Merrill Lynch at the time. The low will probably be in the 2,000 to 2,200 range. You might get a spike below that. Next guy says, earnings are a key factor and so is psychology. I expect the market to go 10 to 20% lower. Okay, the market bottomed 2 days before this at around 2,300 on the Dow. So what you could see was, again, most people were at the bottom. They were way too pessimistic. Why? Because things have been really bad. This, I think, is really interesting. This is Paul Tudor Jones after the crash of 1987. Paul Tudor Jones, as you may know, runs Tudor Investments. He's one of the great market traders. And the question he was asked after the crash was, do you see any way in which we can solve our current problems before we go into a deep recession or even a depression? He says, that is what scares me so much. I don't see any blueprint out of our current dilemma. Maybe there are macro forces at work that are part of a larger super cycle that we don't have any control over. Perhaps we're just simply responding to the same type of cycles that most advanced civilizations fell prey to, whether it was the Romans, 16th century Spain, 18th century France, or 19th century Britain. I think we're going to be in for a period of pain. We're going to relearn what financial discipline is all about. Well, that was followed by a 1988 market that was up in the double digits, and a 1989 market that was up around 31%. So he was a little too pessimistic after the crash of '87, as you can tell. Okay, what's at work here is this sort of sheep fact that I mentioned. I think this is a cartoon that I like because this cartoon was done in late 1999 at the height of the tech and telecom and big cap boom in the US. And of course the cartoon says, I don't buy stocks simply because others are buying them. I buy them because many, many others are buying them. I think if you think about that today, just put sell where it says buy, and that's exactly the attitude that most people in the capital markets have today. That's why they're selling, because everybody else is selling. Okay, so let's sort of look at where I think we're likely to go from here. Credit spreads of all qualities are above the Great Depression levels. We're going to have a depression to have these credit spreads not represent an extraordinary buying opportunity for any period longer than the next several months. And in fact, even if we have a depression, these credit spreads are at or above depression levels. Okay, this just puts it in a little closer context. You can see how far the AAA corporate spread is to treasuries, how far the high yield corporate bond spreads are based on history. Again, extremely wide spreads in the credit markets. Even if you get all-time record defaults, you're still going to do very, very well in the corporate bond markets with anything approaching intermediate and longer-term maturities. In the stock market, valuation spreads, the equivalent of credit spreads in the bond market, they are also at extremely high levels and they appear to have peaked in the late fall. After valuation spreads peak, the market is typically strong. So if we had a peak in valuation spreads in the fall, then if it's like on average, then we'll get about a 34% gain in the US equity market in the next 12 months. And in the next 2 years, about a 45% gain on average. The S&P right now is more extended to the downside than at any historical bottom in the last 30 or so years. This is the difference between the S&P relative to its 200-day moving average, which gives you a picture of how that sits, how much emotion is available in the overall market. This is one of my favorite charts. This is a chart of rolling 10-year annual returns in equities. This is the worst 10-year period in the U.S. S&P 500 since the data have been being compiled, minus 2.1% a year on average every year for the past 10 years. 10 years is sort of long-term for most people. And you can see this is the worst period. You can see the last time we had this was the summer of 1982, and that led to the beginning of the biggest bull market that we've seen in our lifetime. This is a distribution chart of the 1988 return, of the 2008 total return relative to the last 82 years. There have only been 6 times in 82 years the stock market's been down more than 20%. Last year was one of those, as we were down, as you know, the worst since 1937. The important part of this chart is that only one time in history has the market been down again after being down more than 20%. Or more than 30%, and that was the 1931 to 1932 period, and in 1932 the market was down single digits. We are already down in the first 3 months of this year almost 20% in the U.S. equity market. So if in fact the market just stays flat from here, it'll be the worst 2-year period in the entire history of the U.S. market. If we're actually going to get growth in the second half of this year, you are likely again to be somewhere in the bottoming range for the U.S. market, and I'm just using the U.S. as a proxy, a stalking horse for most global markets. The U.S. market bottoms, the U.S. market starts up, the global market's been so coordinated that they will all be rising. This chart is just a different version of something that I showed you earlier, putting it in a different perspective. Very incredible opportunities for long-term investors. That January 31st report down at the lower right-hand part of this just shows you how expensive bonds are, 35 times earnings, versus the S&P 500 at around 10.8 times earnings properly calculated. This chart gives you a different perspective. What this says, the thing I want to call your attention to is the very first line there, that minus 44.8%. That is the S&P 500's return from the peak in 2000 to today. And you can see that out of the other asset classes or different ways you could invest, that's about the only one that didn't do well. Everything else did quite well. During that time, unlike most other times in capital markets, earnings went up a lot. They went up 35.4% a year. The dividend yield went up dramatically over that period of time. 10-year Treasury notes fell. You made a lot of money in Treasuries, but the PE ratio in the market collapsed, and it stays at a low level today. Okay, this just shows you the percentage of S&P 500 companies in the U.S. that have dividend yields higher than the 10-year T-note. As you can see, going back almost 30 years, this is the highest we've ever experienced by a factor of 4. The last highest was in 2002 at the bottom. All of these data points are data points indicating extreme bearishness, extreme pessimism, what Sir John Templeton called the point of maximum pessimism in the overall market. This puts in context that 10-year chart that I showed you about minus 2.1% a year. So in February of 1999, the S&P looked like that, 28 times earnings, meant a 3.5% earnings yield, a 1.1% dividend yield, treasuries are 5.1%, and the Fed fund target was 4.75. As you can see right now, stocks are very, very cheap, again, compared to the alternative. This is the top 10 names in the S&P 500 today versus 1999. Again, 1999, a time of high optimism in the markets, because returns have been great for the previous 5 years. 2009, a time of great pessimism in the market. So great optimism in the market, 1999 gave you the worst 10-year returns in history. The great pessimism in the market today, I would suggest to you, gives you a great opportunity to anybody who's a long-term investor to begin to commit capital. Okay, you say, well, but how can the market go up if the economy is so bad? Well, here's how. This is a list of all quarters in the post-war period that we've been down more than 4% in GDP. I won't dwell on this chart. I will just note to you that on average, the average has been minus 5.8% down there at the bottom. You see the Q4 2008, when I put this chart together last week, that was the preliminary GDP number. That number is now spiked to 6.2% when the final revision. You can see also that on average, in every case where the GDP has been down greater than 5%, the next 12 months, the market has been up on average 25%. So good market returns always begin from periods of market pessimism. Where's the money going to come from to buy all this stuff since everybody's lost all this money? Everybody has gotten liquid. Money is sitting in money market funds. It's the highest amount of money market fund assets as a percent of the S&P 500 market cap that we've seen, again, in the post-war generation or since money has been being, this stuff has been being tracked. All of this is earning effectively about a 0 rate of return right now. You can put it in the S&P 500 and get a dividend yield of 3.5% or so on high-quality companies with good and growing dividends. About, I think, 16 of the top S&P top 50 companies raised their dividend in the last 6 months. Okay, Warren Buffett. Warren rarely talks about the market, but there is a reason he's the richest or second richest guy in the world. And he's talked about the market as the market about 4 times in history, and you can see it right there. The last time was October the 17th, when he said he was buying U.S. equities. And if you read his annual letter over the weekend, I would urge you to do that. He talks about how the economy is poor, but the outlook for the long-term investor, and his point being that people that have money in cash right now or in treasuries would be well advised to move that out the curve and into longer dated assets. Okay, so finally, where do we go from here? I think the outlook in the U.S. and by extension the rest of the world, because the rest of the world now is completely coupled in this market. We're at 12.5 times 09 earnings. Free cash flow yields comfortably exceed the Treasury 10-year note yield. Balance sheets in the U.S. among non-financials are among the strongest in history. So, you know, about 30 years ago, a friend of mine, I was in the military then, but a friend of mine had just started Harvard Business School, and he said the professor came in the investment class, and he said, I want to talk about investment strategy. He said, can anybody sort of give me a, recite a little bit about investment strategy and what you know about it? And so people began to talk about, capital markets theory and risk reward and that kind of stuff. And he said, no, the core of strategy, what is it? And so people kind of puzzled. He just said, the core of strategy is buy low and sell high. And I would suggest to you, we're at the same point right now. This is what is cheap right now. Bonds of longer maturities, anything from investment grade to high yield, I think can comfortably be bought. Large cap stocks anywhere in the world that have solid balance sheets, decent yields are all on sale right now. I think they can be bought. And what ought to be sold is the stuff that's likely to have the poorest returns over the next several years, and that would be cash and treasuries. And let me just end by saying that it's the thing that I think you should keep in mind here is that how quickly things can change. It seems like right now, I mean, I know every day I wake up, actually I wake up at 3 or 4 o'clock in the morning in the US, I check the futures market, it always says the same thing, down 1%, down 1.5%. Look at the Asian markets, they're down 2%, and so actually I look at the commodities markets first, because the oil market's down, then I know that all the market futures are down because everything is correlated. So, but it's interesting to think about that only in October of 2007, so it was at 15 months ago, the S&P was at an all-time high, 15 months ago. It was only in July of 2008, what's that, 8 months ago, that oil was $147, and now it's in the $40 range. So the point being that what seems at the time to make perfect sense and to follow a trajectory that leads you inevitably to where you are today has a way of changing much more rapidly than you can ever conceive of it. And I think that the surprise in the markets right now globally is that we have reached or are within 30 to 60 days of reaching the point of maximum pessimism that will then lead to, I think, good returns for long-term investors across any longer-term asset class. So with that, I'd like to thank you, and I don't know how our time is running for Q&A, but yes, happy to do it.
Thank you, Mr. Miller. Please feel free to ask your question right now. We have 2 mics on the sides.
I also have up here with me my colleague Sam Peters, who's a portfolio manager who will answer the more difficult or the questions where people don't agree with me. Yeah, over here, sorry.
Thank you.
I have a question here.
Where are we? Okay, great.
Okay.
Yes.
Basically, you spoke about the current crisis as being a collateral-driven crisis. And you mentioned truly that the reason for this is the collapse of securitization, shadow banking, structured finance, etc., i.e. the collapse of financial innovation, which was really an important part for the growth that we have seen in the past few years. And you spoke about policy errors and that the policy decision makers ran out of policy errors. Now they have increased money supply, as you mentioned, in the MV equals PQ. They have increased money supply quite a lot. But we know basically that when financial innovations drop, usually velocity drops. And what do you think about this? I mean, no matter how much money supply you inject, as long as there is no financial innovation, which you said the securitization and shadow banking is about 60% of credit, how will this lead us, basically? Where do you see the end?
So I would distinguish between the collapse of instruments or consequences of financial innovation from the collapse of financial innovation itself. So the innovations of securitization and structured financial products and all, those innovations, they have happened, they exist, and they can be drawn on. It's one of the points that flows out of what Keynes said in 1930 about all of the technology that had been developed up till that time still existed, it just wasn't being used. And I think the point that you might be driving towards is that the policy needs to make sure that it doesn't stifle future financial innovations, and it needs to make sure that it allows the financial system to adapt and to come up with products and instruments that will enable credit to flow again in different ways. The problem has been that any good idea carried to excess can cause problems. The issue with securitization markets, I think the open issue there is how much can they be brought back by something like that term auction lending facility, and how much are they just sort of stuck at the sort of bottom of the elevator shaft, to use again a Keynesian metaphor. But I agree with you that it's going to be very difficult